Petrodollar dead or just evolving? For nearly 50 years, one silent agreement shaped the global financial system. Oil would be priced in US dollars, and the world would need dollars to buy energy. This arrangement, often called the petrodollar system, did not just influence oil markets. It reinforced the dominance of the US dollar itself. But now a question is resurfacing in financial and geopolitical circles. Is the petrodollar system ending? To answer that, we first need to understand what it actually is. In the early 1970s, after the collapse of the Bretton Woods system, the United States faced a problem. The dollar was no longer backed by gold. Confidence needed a new anchor. That anchor became oil. Through strategic agreements, particularly with Saudi Arabia, oil exports were priced exclusively in US dollars. In return, oil producers recycled surplus dollars into US Treasury bonds and Western financial markets. This created a powerful loop. The world needed dollars for energy. Energy exporters accumulated dollars. Those dollars flowed back into U.S. assets. U.S. borrowing costs remained structurally lower. It was not a formal treaty system. It was a strategic architecture, and it worked for decades. But systems built on stability can begin to shift when the global order shifts. Today, several developments are challenging the exclusivity of dollar-based energy trade. China is now the world's largest energy importer. Saudi Arabia increasingly trades with Asian partners. BRICS nations discuss alternative settlement mechanisms. Russia has redirected energy exports toward non-Western markets. Some oil trades have already occurred outside the dollar. This does not mean the system has collapsed, but it does mean the monopoly is being tested. The real question is not whether one oil shipment is settled in yuan or euros. The real question is whether the structural recycling mechanism weakens, because the power of the petrodollar was never just about invoicing currency. It was about demand for U.S. financial assets. If oil exporting nations accumulate fewer dollars, they may allocate reserves differently. And if reserve allocation patterns shift, capital flows shift. That is where financial implications emerge. At the same time, the United States remains deeply embedded in global financial infrastructure. SWIFT systems, dollar clearing networks, treasury markets, global banking liquidity. Replacing this infrastructure is not simple, nor is it fast. The dollar still accounts for the majority of global reserves. Most commodities are still priced in dollars. Global debt markets are overwhelmingly dollar-denominated, which means the system is not fragile in the way headlines suggest, but it may be evolving. And evolution matters, because evolution changes the marginal flows first, not the core. If energy exporters diversify settlement currencies gradually, reserve managers adjust allocations gradually. Gradual shifts rarely make headlines, but over time they compound. One of the clearest signals to watch is settlement experimentation. China has promoted yuan-denominated oil futures. Some bilateral trade agreements now bypass dollar clearing. Central banks are increasing gold purchases at multi-decade highs. Gold buying is particularly telling. Gold represents neutrality. When central banks accumulate gold while discussing alternative settlement currencies, it reflects hedging behavior. Hedging behavior signals uncertainty about long-term currency architecture. This does not imply imminent dollar collapse, but it does imply strategic diversification. Now consider the geopolitical layer. Sanctions policy has expanded significantly over the past decade. Access to the dollar system has been weaponized in certain contexts. This strengthens short-term leverage, but it also incentivizes long-term alternatives. If countries perceive vulnerability to financial exclusion, they explore parallel channels. Parallel channels begin small, then mature quietly. The petrodollar system was not built in a year. It evolved across decades. If a shift occurs, it will likely follow a similar timeline. Which brings us back to the original question. Is the petrodollar dead? Not structurally, but perhaps no longer unquestioned. And in financial systems, being unquestioned is power. Once questions begin, probabilities change. And probability shifts is what markets eventually price. If the petrodollar system were to weaken, even gradually, what would that actually mean? The first thing to understand is this. The dollar does not dominate simply because oil is priced in dollars. It dominates because global trade, global debt, and global liquidity are built around it. But energy is a foundational layer. Energy demand is universal. Every economy needs it. And historically, that universal demand reinforced dollar demand. Now, imagine a scenario where a meaningful share of global energy trade is settled in alternative currencies. Not overnight, not dramatically, but progressively. China settles more oil imports in yuan. India settles certain trades in rupees. Regional blocs experiment with cross-border clearing systems. Each transaction on its own seems insignificant, but marginal flows matter. If oil exporters receive fewer dollars, they accumulate fewer dollar reserves. If they accumulate fewer dollar reserves, they buy fewer U.S. Treasuries. And if foreign demand for Treasuries softens at the margin, yields must adjust to compensate. The United States currently carries historically high debt levels. Refinancing that debt at higher yields increases fiscal pressure. This does not create immediate crisis, but it reduces flexibility. Higher interest expenses constrain policy options. Constrained policy options increase sensitivity to shocks. Now layer in global reserve allocation. The dollar still represents roughly 58 to 60% of global reserves. That is down from over 70% 2 decades ago. The decline has been gradual, but gradual declines can become structural trends. Central banks are not necessarily abandoning the dollar. They are diversifying. Diversification is rational. Holding reserves across multiple currencies reduces exposure to sanctions, policy shifts, and geopolitical risk. Gold purchases by central banks have surged in recent years. Some of the largest buyers include emerging market economies. Gold does not pay interest, but it does not depend on political alignment either. That tells us something about sentiment. Now consider capital markets. If global energy trade becomes more multipolar, currency volatility increases. Oil is one of the largest traded commodities in the world. If pricing fragments across currencies, hedging complexity increases. Energy companies must manage multi-currency exposure. Investors must model cross-rate risks more carefully. Volatility feeds into derivatives pricing. Derivatives pricing feeds into corporate balance sheets. Again, no collapse, but more friction. Friction increases cost. Now, think about emerging markets. Many emerging economies borrow in dollars. If the dollar weakens structurally, their debt burden may ease in local currency terms. But if the transition is disorderly, currency mismatches could expand. Capital flight is often triggered by uncertainty, not just fundamentals. If investors perceive systemic shift, liquidity can evaporate quickly in fragile markets. That is why transitions between monetary regimes are rarely smooth. History offers perspective. The British pound once anchored global trade. Its dominance faded gradually after World War I, but it took decades. Reserve currency transitions are slow. They are complex. They involve trade, military power, financial depth, and trust. Trust is the most important variable. The dollar's dominance rests on trust in U.S. institutions, rule of law, market depth, and military reach. Those pillars still exist, but global confidence no longer feels absolute. And absolute confidence is what sustains hegemonic currency systems. Now, let's address the most common misconception. The petrodollar system ending does not mean the dollar disappears. The dollar can remain dominant even if oil trade becomes partially diversified. But dominance at 60% is different from dominance at 75%. Marginal change matters, because marginal change affects pricing power. If fewer global transactions require dollars, global demand growth for dollars slows. Slower demand growth intersects with rising supply, especially when deficits remain large. And that intersection shapes long-term valuation. Currency shifts do not happen through dramatic collapse. They happen through incremental repricing. Treasury demand softens slightly, yield curves steepen slightly, foreign reserve allocations rebalance slowly. Markets adjust, and then adjust again. The more interesting question may not be, is the petrodollar dead? It may be, is the dollar entering a multipolar era? Multipolar systems are inherently more volatile. When one currency dominates, trade flows through a single clearing channel. When multiple currencies compete, capital fragments. Fragmentation reduces efficiency. Reduced efficiency increases cost. Higher cost reduces global growth potential. This is why central banks monitor settlement experimentation closely. It is not about ideology, it is about systemic stability. So, where are we now? We are not witnessing collapse, we are witnessing testing. Testing of alternative settlement rails. Testing of bilateral currency agreements. Testing of gold accumulation strategies. Tests reveal resilience or weakness. And markets are watching carefully. The petrodollar system is not ending in a headline moment. If it changes, it will change in the margins. And margins are where structural shifts begin.